Hello, everyone. We will get started in a minute or so, so please bear with us. While you're waiting out there, if you want to introduce yourself via the chat window, you can do that. Make sure that your settings are chatting with everyone. Okay, so as you join here, feel free to introduce yourself via the chat window. And we still got people that are joining, so I'm still going to give it about 30 seconds or so, and we'll get started then. Okay, wonderful. So welcome today to everything you wanted to know about 409A valuations. My name is Dan Dato. I'm your host today. I'm the Chief Marketing Officer at Early Growth. I joined the firm about a year ago, but my background has been as a serial entrepreneur. I got to know Early Growth because I was a client of Early Growth. Oddly enough, today I was also a client of our guest speaker, Bryson Lord, when he was the founder of Greener Equity. And he was my 409A valuation firm for the last business that I started. I'm coming to you today from Los Angeles, but I'm originally an East Coaster. I've been in LA and around LA for the last 25 years, so this is home. As you guys introduce yourselves via the chat, feel free to say where you're coming from, drop the name of your company, and please do it for, make sure that you're chatting to everyone and not just to us, so that we can see it, so that everyone can see it. As the webinar goes today, feel free to drop your questions anytime into the Q&A panel. I'll be keeping an eye on that as Bryson is talking through the subjects, and we'll intersperse your questions. So don't wait until the end. If you've got a question, drop it in the Q&A panel. It may get lost in the chat. So if we're not addressing it, if you drop a question in the chat and you're wondering why we might not be addressing it, and we might just not be seeing it, so drop it in the Q&A panel. We're recording today, and so we will share a copy of this presentation as well as the underlying presentation in a PDF via email afterwards. So you don't need to scribble notes or do screenshots or take pictures of your computer screen. You'll have it all after the fact. Before we get started today, I just wanted to give a quick introduction about Early Growth if you're not familiar with us. Early Growth is the accounting and finance function for early stage companies. We take care of the entire function from the CFO and years of experience of CFOs working with startups who are going through the issues that many of you are going through, raising funding, figuring out how to grow, preparing financial plans when you've got no financial history and you're really in an uncertain environment, to the day-to-day accounting. And I had a financial background and I hired Early Growth. I was a CFO, I was a CPA, and I still hired Early Growth because as a founder of a company, I needed to focus on other things than the finances. I needed to focus on my customers. I needed to focus on my team. I needed to focus on my core business. And so Early Growth is kind of like an offensive lineman. We're there to give you the time so that you can do the special things as the quarterback of your team. And take care of, as I said, the finance and accounting. We also do taxes. What we're talking about today, 409A valuations, we do in partnership with Bryson's firm, Economics Partners. And we also represent startup investors. So we've been around for a long time, over 11 years. We've represented thousands of startups. We started in Silicon Valley, but we have a global footprint now. And the CFOs that are part of the early growth team are pretty extraordinary folks. These are folks that bring 20 plus years experience to your business far earlier than you'd ever be able to afford hiring them full time. Over the course of 11 plus years, we've represented some pretty recognizable names. Somewhere about 1 in 6 venture-backed companies are our clients. So with that, I'm going to turn it over to Bryson to introduce himself, but we're lucky to have him here today. Again, I was a client of his. And so as we go through the subjects today, I will talk from the perspective of, I think you guys, from the entrepreneur and the client. But let me turn it over to Bryson. Bryson, thanks for joining us today.
Great. Thanks, Dan. It's great to be with everybody today. And thank you for participating in this topic. As Dan mentioned, I'm a partner at Economics Partners. Was also involved with Greener Equity, which is a valuation firm founded principally on this topic of delivering valuation services to startups and high growth businesses. I have a background in accounting and finance and hold a CPA license as well as accreditations and valuations from the American Institute of Certified Public Accountants, the AICPA. You may hear that acronym. And guidance, they issue a lot of guidance that we follow. And so that's an important governing body for us. And I'm based in Salt Lake City, Utah. My team here in Salt Lake consists of about 15 professionals and my co-partner who we lead the evaluation practice here at Economics Partners. A little bit more about Economics Partners or Econ Partners or even EP. There are 8 partners, 2 of us in Salt Lake City, 3 in Denver, 3 in Washington, DC, roughly 55 professionals across the country. And all day, every day, we perform valuations to support tax positions such as 409A, to support financial reporting positions, strategic considerations, and so forth. Our client mix goes across the spectrum. We service large public companies of names that you've heard to founders who literally have an idea in a PowerPoint presentation, pre-revenue, pre-product, and everything in between. And as mentioned, we offer an array of valuation and tax consulting services. The tax consulting services align with valuation specific items and issues, restructuring, transferring assets from one legal entity to another, intercompany transactions, and valuations we'll talk about today.
Awesome. So, so today, I think there might have been one slide I missed in here that I went through kind of quickly and didn't mention. I'll talk about it a little bit later afterwards, but we are offering a special this month on the 409A valuation services of $500 off our standard pricing. It ends at the end of June. If you're interested, just reach out to us. And again, you'll get all the information afterwards. So today we're going to cover kind of the key 5 questions around 409A valuations, just starting with what it is. And then we're going to address some questions. One big one in the room is, does the current environment change my needs for a 409A valuation? Or if I had one, do I need to update it? And so we'll talk a little bit about the COVID-19 implications, but let's just start it off. There'll be a lot of content in this presentation. We'll talk through some of the key points. We're not going to talk through every item on each of these slides. So as we're going through this, again, if there's something that we don't talk about that you'd like to know, please feel free to bring it back up in the Q&A. So with that, Bryson, what the hell is a 409A valuation?
Yeah. 409, it's interesting, that name 409A is similar, it's a section of the tax code. Like we all know what 401k plans are, and 401k is nothing more than the name in the tax code that governs 401k plans. And so 409A is a section of the tax code in the United States that governs non-qualified deferred compensation. And this section is large, 409 is a large section. But for most of us in this webinar And when we hear 409A valuations, we think stock option plans, compensation plans like stock option NSOs, and that's really where we're going with this. It came from the Enron days when executives would say, hey, we won't pay you any salary. We'll just give you penny stock options, meaning stock options in the business with a 1 cent strike price. Even though the stock is worth much more, we'll give it to you already in the money where there's value there. You can exercise it for a penny and then hold a share of stock that's worth tens, 20s, 30s of dollars, and you'll have immediate compensation. And the IRS said, timeout. We need to set up some rules around this because that's real value these employees are receiving when they receive a penny strike on their stock option when the actual underlying security, common shares, is worth much more than that.
Right. And so this concept of non-qualified, like you mentioned an NSO, which is a non-qualified stock option, that really relates to insiders, to employees, right? Qualified or incentive stock options or qualified compensation is typically going to be for outsiders, contractors, and what have you. Is that fair?
Generally so, yes, Dan. There's a lot of rules around this, but yes, most cases, non-qualified deferred compensation plans are to your employees and to the individuals you're trying to incentivize and compensate for bringing value to the organization.
Okay. So the what here at a high level is this is driven by the tax code. It's a valuation in response to a requirement in the tax code that typically relates to, there's a few different conditions as to why you might have some compensation occur that would drive a 409A valuation. But for us here today, we're gonna stick to this idea of it's when you're granting options to your employees.
Yep.
All right, so why do we need one?
Yeah, we need one. Back to that point in the Enron case, if the share of stock is worth $20 and I deliver an option to buy that share for a penny, there's $19.99 of value that recipient is receiving. The IRS says, I'd like to tax that value. And so as you see in that second bullet, the third bullet, if the exercise price is less than the fair market value of that share, there's compensation value received by that recipient. And so we're determining if you're a private company, you don't have active transactions in your shares, you don't know what the fair market value is of the stock. Therefore, you need to determine what that is, and you need to ensure you're pricing the strike prices of your options on that second bullet at or above fair market value, so the recipients aren't stuck with a tax bill later down the road that they weren't aware of. And as long as the exercise price is equal to or greater than fair market value, there's no compensation for the recipients. And if you aren't complying with these rules, as we have in the fourth bullet, there can be penalties not only to the corporation, but also to the recipient who receives that value, the value below fair market value. So there's can be a tax bill and there can be penalties on top of that. So it's important to ensure we know what the fair market value is of the common stock in our business. And then also we're setting the exercise price on these options at or above fair market value. So there's no compensation tax bills to those recipients. Or if we do set it below the fair market value, we can, but we want to make sure we know that and we're aware of what the tax implications are.
Right, right. Yeah, I mean, from my perspective as an entrepreneur, I've both granted and received shares above and below market value, and understanding that you have compensation, that tax compensation can add up to be thousands of dollars when you don't have any cash to offset it. And so it can be a pretty big hit. It's still something you might want to do, but you want to recognize that you're doing it. So with a 409A valuation, we've got this concept of fair market value. That's ultimately what we're determining here so that we understand if there's compensation or not. Is that fair?
No, that's absolutely right. And fair market value for a private, illiquid, high growth company can be tricky to determine, which is what we're going to walk through here. But that's the key concept, as you're saying.
Okay, before we get into how we determine it, maybe let's talk a little bit more detail about when we need one. So we mentioned that the idea of when you're granting stock options to founders and employees, but there's some other information here as to updating it, and maybe you can give us a little insight there.
Yeah. The typical instrument companies use to incentivize employees is stock options, but also the company can grant shares, they can grant other instruments, and so when the same concept, it doesn't matter whether you're granting stock or granting options, you want to know what that fair market value is. Most attorneys I speak with and most advisors say, if you're a startup with an idea, pre-product, pre-revenue, it's you and your partners, you're bringing on, a CTO, and it's very early, you bootstrapped it to date, most attorneys will advise there's no need to have a formal 409A valuation, set the strike price at par. But as soon as you take outside capital, as soon as you have angels involved or convertible note instruments or seed financing, now we really want to be aware of this section of the tax code. And that's when you strongly need to consider getting your first formal 409A valuation. And that report where the fair market value is determined is good. That report is good for 12 months or until there's a material change in the business, whichever one happens first. And so the longest shelf life.
That's a pretty vague statement, a material change.
Yeah, material change means what, right? For a startup, that could be we launched our product. It could, most of the time it means we've raised another round of capital. That's certainly a material change in the business, but it could not only be that. It could be we launched a product, we pivoted our business, we changed our revenue model completely. We brought on a very key executive that we expect tremendous growth. So material is subject to interpretation and it's vague in the regulations. And so having a really robust dialogue with the founders, the board, and perhaps your counsel as to when do we need to update our evaluation, has there been a material change? Everybody needs to be aligned with that decision point. But at maximum, it's every 12 months, but perhaps it's more frequent than that. And I have there in parentheses, COVID may have created a material change in your business, meaning we thought we were trending at X and now we're trending down at Y, or perhaps we're trending at X, now we're trending at 2X or 3X. And so that may have caused a meaningful change in your business where the old report, the prior report, is invalid. It's obsolete because there's been so many changes in the business and the macro environment.
Okay, we'll come back to that towards the end. But yeah, that's a pretty broad term that feels like it requires some expertise and some experience to be able to judge, has my business undergone a material change? At a minimum here, you're updating it every 12 months though.
Yeah, let me jump in here, Dan. There was a question that one of the participants asked, would a large contract with a customer be considered a material change? And I had a finance professor in graduate school who said, the answer always is, it depends. Right? It doesn't help, but it depends. And so my advice generally to my clients is, if your outlook of your business on a valuation today, if your outlook in your business considers a potential large customer contract or considers some growth, and that was already factored into the valuation, even though you signed it, it may not constitute a material change in the business. But if it was a surprise contract and that contract is meaningful and that was not factored into the prior valuation, that may constitute a material change in your business. And again, these are not fine lines. This requires discussion among the board, among valuation professionals, with legal counsel, but that's generally the way I look at large customer contracts.
Okay, so great. Now we know what it is and when we need it. Maybe we can talk a little bit about how it's calculated. Now, this is a pretty complicated subject. In some respects, I think a lot more complicated than people think until they go through it for the first time. And maybe you can provide a little insight into how this valuation is calculated, how it the different methods that are used and how it differs from some other valuations that are done with the business.
Yeah. The valuation, like we said before, these are illiquid companies. There's not an active market. And so we're being hired to render an opinion of what we believe the fair market value of those instruments are. And there needs to be mathematically supportable, but it's also, in the second bullet, there's a lot of subjectivity. And just as when you go out of the market to raise capital, you can receive term sheets from various professional investors where the range of value can be quite large. We try to take a pragmatic approach with our clients, knowing that there is a range, but really what are the facts? What is the management team? What is the market? How has the business performed in the past? What do we expect in the future? And utilizing the three methods, the tools in the toolbox of an asset approach, an income approach, or a market approach, or some combination of those three. And we'll talk a little bit more about that in the next slide. But we'll look at those mathematical approaches in context of the broader qualitative factors. Again, market, traction, management team, product development cycle, and so forth. And we synthesize that all down, and we have to recommend a number or a range of numbers. So it's taking the opaque, crystallizing it, building a mosaic, and then coming down and utilizing formulas and mathematics to support a single value. That's the fun of this business, in that it is subjective, but yet we have to ground it in economics and cash flows and competition.
Yeah, I think from the entrepreneur's perspective, one of the things that I needed to wrap my head around the first time I went through this process is that we're not just trying to put a valuation number on the company. And that's part of this process. But when you get that number, you don't just divide that number by the number of shares that you have outstanding. You have to recognize that you've got different types of shares, and an option is not the same thing as a share, that the option itself has a value. And so I think we're going to talk a little bit about that in a minute. But this was about some of the different valuation methods. And I think there's only one in here that typically ends up being relevant for startups, but maybe you can give us a little background on these.
Yeah, these methods are well known in the valuation world. An asset approach, think about that, right? What's the value of a business that has a lot of assets? You add up the value of each one of those individual assets and the liabilities associated with those assets, and what's left over is the value to the owners of the business. Really common for capital intensive businesses, real estate as an example, or machinery or holding companies. The income approach is based on the theory of cash flows. What is the forecast, the outlook of the business? And discounting those cash flows back to present value. That's the value available to the owners of the business. The market approach, very familiar with this in a market. It's what somebody else is willing to pay for it. And there are comparable transactions and comparable companies that the subject company can be compared to. And then the last bullet, the back solve method, is one where a recent financing has occurred, which is typically in venture and private equity. The recent investment is in a preferred share of stock, a preferred class of stock. And that preferred class has, call it superior economic rights than common shareholders. Typically have liquidation preferences and conversion rights, in addition to voting rights and perhaps even anti-dilution rights. And that price paid per share or per preferred class imputes a value of the company, and we can waterfall that down to common shares, knowing that common does not hold the same liquidation preference rights or the same conversion rights or dividend rights. And as you said earlier, Dan, common shares without those preferences is certainly worth less because it does not have the same downside protection as preferred shares has. So the back solve method backs into the value of the company, waterfalls it down to common stock. That's what the back solve method is. And it's most relevant because the market has said and spoken, we think the company is worth X. We think preferred shares in this business is worth X. And in fact, we believe it so much we have transacted and made that investment. That's a pretty solid data point as to what the value of that class of shares is, and then we can impute the value of the common shares accordingly.
So, so as you go through this as an entrepreneur, you're wrapping your head around all the complexities and the subjectivities of valuation methods. And then you end up at a point where for probably 98% of startups, you back into the answer. And for me, there was something that I just went through and said, this doesn't make sense. This doesn't seem that complicated. And yet there still is a ton of valuation and subjectivity that goes on to get from that backed in, that back solved price per preferred Series A back down to what is an option to buy a share of common stock worth. At this point, we're just starting the valuation process, not finishing it.
Yeah, there definitely are a lot of inputs and subjective components to that, rather than just, the post-money valuation is the most common that we're accustomed to, right? The number of shares times the price per share, that's the post-money value. But wait a second, we've got to consider all the rights and preferences in the capital stack before we get down to the price of common shares.
Yeah. There's a term on here that might be worth talking a little bit about. It's just what a waterfall analysis is. You hear that, and if you haven't gone through the valuation process, you might not be familiar with what a waterfall is. Maybe you can share a little insight as to how that's calculated, and when you're doing the 409A, how you kind of build up to a valuation with the waterfall.
Yeah, the waterfall is if the company were to sell or liquidate or wind things up, what would each share have claim to? What would they receive in cash value? And if preferred shares have a preference of receiving their distributions before common shareholders. And so what we do is we model scenarios, we take a value and we waterfall that and push that through the capital stack based on liquidation rights and preferences, if they're accruing dividends. And guess what? If we also model in if the company were to sell for much more, what would happen to those liquidation rights and preferences, because perhaps the preferred shareholders would give up their liquidation preference rights and convert to common shares. And so a waterfall is nothing more than pushing and forcing that value through the different rights and preferences within the capitalization table.
Okay. Moving forward, so company value doesn't equal common stock doesn't equal option value. This looks really complicated, Bryson. What is this?
It is complicated. It's, three PhDs won the Nobel Economics Prize for coming up with it in the late 90s. But the point here is that one of the most fundamental allocation models we use is the option pricing model, the Black-Scholes option pricing model. And there are some key inputs into this option model that entrepreneurs should be aware of when we allocate value through the capital stack. And a couple of those inputs would be the estimated time to maturity, or call it a liquidity event. That's typically the exit event. And so if we expect this business to sell in an IPO or an M&A event in 7 years, that's a long time. And therefore the option value is over that 7-year life is much greater than if we expect this business to sell in 2 years. So that's one fundamental input into the analysis. Another one is volatility. How volatile do we expect that stock to be? And that is based on public market data. It's not perfect, but it's a surrogate, and we have good data in the public markets. If it's a highly volatile stock, and for startups, you'd expect volatility to be on the higher end of the range than for very mature public companies. If it's more volatile, there's more value in that option. And so, and if it's less volatile, there's less value in that option. And so those are some of the key inputs. There's certain industries that are inherently more volatile than other industries. And so definitely that plays a factor into that as well. Other industries where there's a very long time until we expect there to be a liquidity event, and other industries where you can build and sell a business very quickly. So those are some of the key inputs into the option pricing model that we use to allocate value through the capital stack.
Okay.
I'm not an expert in it. You're not expected to be an expert in it, but you should be aware of some of the key components that go into it.
And volatility is a concept that can be impacted by the external environment. So you're looking maybe at the public markets as an indicator of how volatile pricings might be. And as we see the market go up and down and up and down in large numbers, that might be an indicator that there's a higher level of volatility out there. And the more volatile the market, the more likely that the stock price is going to jump, because volatility doesn't say it's going to go up or it's going to go down. It says it could go up or down by a great amount. And so that would indicate the stock option. The fact that you have an option to buy has more value, more underlying value, the higher the volatility.
Certainly. Yeah, public markets isn't a perfect analog to the volatility input, but it's a really good analog because there's really good data there. And we're saying, like you said, Dan, if there's recent volatility today and we expect that to persist over the near term or even the long term, that's a great measure. If we expect that volatility to not be present in the future, then maybe we should use a little bit different volatility. So there's some subjectivity there in volatility, but it is an key input, as you said, because the value may increase, it also may decrease, and we don't know.
Yep. Okay, so this is a bit of a recap here, but it sounds like there's a dozen ways to skin this cat. Of what is a share of stock worth, what is a company worth, what is a stock option worth. So, if you were to recap this for an entrepreneur, what do you think are the most important concepts to come away with when they're thinking about valuation, and then how a 409A is different?
Yeah, this valuation, recognize the purpose of this valuation is to support a tax position. It's a tax valuation. And it's going to differ than your post-money valuation in your Series C or Series A or Series B financing, because we're not taking the price of that preferred share and multiplying it by the fully diluted cap table. So I would say, number one, this is a tax-driven compliance need. Number two would be, there are multiple methods and ways to think about arriving to the company value and allocating that value through the capital stack, and being able to navigate those methodologies is really important, and selecting the best method or methods to support that analysis is really important. And then number three is know that I just philosophically, I believe valuation is a range. Right, it's a little bit disingenuous in my mind to say the company is worth $15,477,923.47. That seems a little overly precise.
Right.
But it may be between $12 million and $18 million, depending on who's aligned and the assumptions and the credibility behind those assumptions and the person on the other side of that table. So that first bullet is really important too. It's a subjective process, and it's in the eye of the beholder. So I think those 3 points and those 3 takeaways is what I would say are critical as an entrepreneur as you're navigating this world.
Yeah. So 2 things before we go on. One is I want to clarify something I may have said earlier that was pointed out by one of our attendees. In talking about ISOs and NSOs, I may have actually flipped the concept. The concepts itself are worthy of an hour talk on their own. So I don't want to go into this. And what can distinguish between an ISO and an NSO can get very complicated. But I did flip the concepts between the ISOs for employees and the NSOs, which are basically everything that isn't an ISO, that isn't qualified there. When you're granting options, it's going to be something that's done in conjunction with your attorneys as you draft up your equity plan to ensure the proper tax treatment of those stock options to employees, because there are tax advantages written in the tax code of granting your employees stock options so that they don't have to pay taxes on the increased value of those stock options along the way. They can wait until they're fully vested and exercised before having a tax liability occur. Just wanted to make sure that that was clear issue, kind of an in-process correction. The second thing I want to mention here is we're going to talk a little bit about who can do evaluation. I'm going to put the disclaimer out. We're not getting salesy here, but we do valuations. Economics partners and early growth together do valuations. We will present to you who else does them. But we're going to give you a little bit of why we think we're a great partner to help you get a 409A valuation. So with that, Bryson, and that disclaimer, maybe it's worth talking a little bit about who can do these, who the IRS trusts to do them. Because ultimately you just said, hey, we're doing this for tax purposes. So it feels like the IRS is the judge and the jury on these.
Certainly the IRS is for tax purposes, and written in these rules, it describes that a person who has 5+ years of experience in a related field such as investment banking, private equity, venture capital, accounting, finance, etc., is qualified to deliver an opinion on the value of a private company, determine fair market value of a private company. Now, there are a lot of rules governing who can do this, and it does not have to be a third party. It could be somebody at the company that's issuing these non-qualified deferred compensation instruments, a board member, an advisor, but the method has to be documented and has to be grounded in principles. And if you do hire somebody, they need to be an independent somebody, and they assert and hold themselves out as somebody independent. They have the requisite background and experience, and they deliver their opinion in a report format. And certainly, as you mentioned, Dan, we do that. And most entrepreneurs, most startups, again, once they take on outside capital, choose to go to the path of outsourcing and hiring an expert to do it, rather than trying to fumble with it in-house, distractions, who's the right person. You know what, we'll pay, we'll get it done right. We know we're covered, and they do this all day, every day. I can focus to building my business and selling my product. Yeah. Now, in the world today, there are several other, we're one valuation firm. There are other valuation firms who do this work. And we're seeing a lot of the cap table software platforms, Carta, ShareWorks, et cetera, that bundle valuation services, 409A specifically valuation services, with their software offering. And my experience with Carta and ShareWorks on their software is very good. Their software for helping administer these plans, removes paperwork, and it's in the cloud. Obviously, you're responsible for ensuring it's up to date. And then there's a feature where they bundle and they offer a valuation in conjunction with your subscription. And my experience, sometimes those valuations are very good. Sometimes those valuations are modest and could use a little bit more oomph behind them. But no, we think we're better because we do this all day, every day, and we're not a software business. And offering this on the side, we're a professional services business. And so that's where I think we set ourselves apart from the cap table software platforms out there.
Yeah. From the entrepreneur perspective, my last business, I used eShares, which became Carta. Here at Early Growth, we work with both of those companies, but primarily with ShareWorks. As an entrepreneur, I loved Carta. I absolutely loved it. And it was just getting started when I started my business. So we did things the traditional way. We had manual ledgers. We worked with our lawyers. We had paper stock certificates. Option plans were a pain to administer, and employees had tons of paperwork. And by the time I exited that business, everything was digital. Employees were able to execute stock options just through an app. They're really fabulous solutions. And so you can sit there as an entrepreneur and fall in love with these cap table management solutions. because they are extraordinarily efficient. They help you do financial planning and what if scenarios based on different exit scenarios and M&A calculations. They're really powerful. But when it came to the 409A valuation, I didn't need just a formula, I needed an expert. And so that's where I worked with Early Growth and the predecessor firm for Bryson, Greener Equity. And so, you know, a little bit here, like why. We understand this market. And I think when we're talking about the whole reason why we're doing this for tax purposes, we want to make sure that it can withstand the scrutiny of an IRS audit, and that it's done in compliance with the standards that are put out there by the AICPA. All of that comes down to a very, very simple formula for me that I use as an entrepreneur across all functions. If things are important and complex, I look to get help. Even if I think I have expertise in it, these are the areas where I look to get the help of an expert. And our partnership here together is not just the valuation, but understanding the inputs are complex, the calculations are complex, the conclusions are important and subjective. And so this is where our CFOs working with Bryson and economic partners, I think can give you the best answer. So end of sales pitch. The other platforms and other options are worth exploring. You should do your due diligence, but make sure you talk to us as well. So with that, we've got about 15 minutes left or so. I did want to kind of kick off Q&A with, hey, COVID-19, does that change anything here? I do see in the chat some questions around, hey, does volatility cut both ways? And there was a question about what's a more important driver, every year or a material event. So Bryson, maybe you can talk a little bit about why COVID-19 might be driving the need for an update and some of these bullet points here as to what that means, good and bad.
COVID-19 has impacted every business in America that I've interfaced with over the last 3 months. And it has impacted generally, and it's pretty disparate. It's either really boosted the business, think the Zooms of the world, where their business model was growing nicely, but because of the digital need with everybody isolating, that has accelerated tremendously. I have clients that are in that category that their business is completely outperforming plan because of the isolation requirements in various states. And then also we have the contrary in the travel industry and the leisure and entertainment industry. Obviously those businesses have been hurt tremendously and value has diminished because customers aren't coming in the door anymore. That could certainly be a material change in the business, both directions, either an increase and also a decrease. Talking about the decrease component, if we were to do a valuation today during a COVID situation where future revenues are meaningfully lower than they were last year, we would render an opinion that the company is worth less now than it was last year, all else being equal. And therefore, certain grants that were made last year are out of the money, whereas we make grants are underwater compared to the grants we would make this year. And so that might be an opportunity to receive a valuation this year and either amend or cancel and reissue those options that were granted last year at a higher strike price. Why? To give your employees who gave blood, sweat, and tears last year to help build the business a little bit more room for the increase in value when hopefully things turn around. And so we're seeing clients certainly take an opportunity now and recognizing that value may be lowered this year, and we're going to cancel and reissue prior options and issue them at the new strike price as concluded in our report.
Yeah, I was just going to say, I think from a mindset standpoint, as an entrepreneur, you're always thinking, how do I push my valuation higher? I want my valuation to constantly be increasing. And your 409A valuation is not going to be completely disjointed from your external investor valuation. As we said, that's typically the key input. However, as an entrepreneur, I want my 409A valuation to be as low as possible, as low as I can support it to be, because it allows me to lower my exercise price. And that allows me to give a better deal to my employees. To all those people who are getting the options, I want the exercise price to be as low as possible. They're not part of my capital fundraising strategy, is in that option holders are going to exercise. So I want to give them the best deal possible. So when this outbreak occurred, the first thing I thought to myself was, wow, I've got employees who are looking at their stock and saying, hey, this had a $2 exercise price, but we're only worth $1 now, which means they're worthless to me. And I don't want employees who are thinking that the very valuable equity I gave up as a founder is worthless. I want them valuing that. So there's an opportunity to reprice and bring it back lower. And I think there was also kind of the parallel track that as a founder, you were going through this thinking, how do I conserve cash? And being able to grant equity in lieu of cash and grant that equity at a lower exercise price is advantageous to you. Now, if you're granting stock with an exercise price higher than fair market value, there's no tax risk. You're just not getting the best bang for your buck related to your equity to your employees. And so for me, as soon as this happened, I started thinking to myself, people, we need to update our 409As. We need to get these back and reprice our options and think about the new options that we're granting, as we might be going to our team saying, hey, I need to cut your salary by 25%, but I'm going to give you some more options. And we wanted to do that at the best value that we could for them. What's this one about the transfer to a trust?
This is again, it's taking advantage of perhaps a depressed environment. As founders and entrepreneurs, many hold their holdings and their business with their own person names. I, Bryson Lord, hold 25% equity in ABC Co. And it's not a 409A valuation, but if I, Bryson, decide to transfer 5% of my holdings or 10% to a family trust for tax planning strategies, and my children or grandchildren or next generations eventually are the beneficiaries of that trust, it might be wise to consider that now, to make that transfer in a depressed environment than in 2, 3, 4, 5 years when that value is much higher. Again, there's tax code implications, and your estate planning attorney can help you navigate that. I just throw that out there to this audience because it may be another reason, one, reprice my options to my employees, and two, I as a founder may want to do some tax planning strategies with my attorney to optimize and minimize the taxes and optimize the opportunity for future generations.
Okay, so there's definitely some opportunities that are created when your valuation is going down. We don't want to see this as founders, but when it happens related to external events, your business can still be going along. You can still be feeling really good about where your business is and where it's going, but understanding that there is some support for what's happening in the external environment that might create some opportunities for both your employees as well as your own personal tax planning. Great. So with that, we've got a few minutes left. I'm going to stop sharing the slides here and come back and address some of the Q&A that's coming in. So one of the first questions that we got was just, does the company type matter? LLC versus C Corp?
It certainly matters. In 409A governs C corporations, that section of the tax code. And so it's the taxation of that. So if you're an LLC taxed as a C Corp, then that is relevant to you. And if you're an LLC taxed in a different form, then then it really isn't under the 409A section of the tax code. It's under a different section of the tax code. And there are different equity incentive plans based on structure as well. Most of corporate America calls it, oh, I need a 409A valuation, and it's really an LLC, S corporation, whatever it may be. So that nomenclature persists of getting a 409A valuation, even though it may not technically be a 409A valuation or be subject to that section of the tax code. So work with your counsel to ensure the right valuation is needed based on the corporate type, based on the equity incentive plan, and then we can get you the right valuation, whether it's a profits interest valuation or just a tax fair market valuation, or if indeed it is a 409A valuation. But most corporate America are C corporations, at least in the startup and the equity incentive world, and most of them have non-qualified deferred compensation plans, and so a 409A is relevant.
Yeah. Yeah, I think, one, the advice to talk to your lawyer. A lot of times that's the right, quick answer when it comes to anything related to this, when we're talking about equity. And then there's also talk to your accountant. And so when we're talking about equity and taxes, that's almost the right path to take, because when you're talking about an LLC, you don't have a concept of stock options, but there's a bunch of other structures that have been created that kind of mirror stock options with membership units. And as you're saying, those concepts are still supported by valuation requirements to show that there's no compensation. The US government didn't leave a loophole there. They're going to make sure that if you're getting something that's below fair market value, that the compensation on it is recognized.
Yep.
Or
I want to address a question. Oh, sorry, Dan. I was going to address a question. Somebody asked about timing and what's more important, if it's done every year or a material event. And if you have an ongoing equity incentive plan and you're regularly making grants to individuals, you would want a current valuation to support those grants. And so at a minimum, that valuation has to be within 1 year from the date of the grant. But if you're not going to make any grants, and your valuation expires, that's okay. The only need of that valuation is to support any grants. And so during COVID, I have had clients say, hey, we know our valuation expired 14 months ago, but we're not in a hiring position. We're not making any grants. We're going to push pause. And when things turn around in the summertime or the fall time or whatever it may be, when we need it, we'll give you a call, Bryson, and we'll get a new valuation on file, and then we'll use that to support any grants. So I think it's not like a business license where you have to have a valuation on file regardless of what you're doing. It's used to support those grants to individuals.
Yeah, that's a very, very important point. You don't need to have a valid 409A in place if you're not doing anything that would require one. And so if you're not transferring equity around between companies or into a trust, and you're not granting stock options, it's fine to let it expire. It's fine that a material change may have changed the underlying valuation. However, once you start granting options, you need to put one in place.
Yep.
There was a question in the chat around discount rate, and I didn't touch on that in terms of how the 409A valuation is calculated. But there are some discount factors that go into valuing a company. Maybe you can talk about the lack of marketability discount and the lack of control discount, where they figure in. The question was very specifically around range of rates that you're seeing. And so maybe you can touch on that as well.
Yeah, there are two factors, as Dan mentioned: discounts for lack of marketability or DLOM, and discount for lack of control, DLOC. The concept being let's start with the DLOC, discount for lack of control, is saying that most grants are of a minority interest in the company. And therefore a a buyer would be willing to pay a higher price if they were to purchase a majority and be able to effectuate change of control or corporate actions by themselves than if they were to buy only a small minority interest in a business. And so there's a gap in value. Most equity grants are only granting a minority stake, therefore they should be based and valued on a minority basis. And if not, if you value the enterprise on a majority basis, then you're allowed to take a lack of control discount to get the value on a minority basis. Somebody mentioned ranges. That can be anywhere from 5% to 20%. I said it broadly. Generally, they coalesce around kind of an 8 to 15% discount for lack of control, generally speaking. There are cases on either side of that, but that's generally the range for a DLOC. And then the other concept for DLOM, or discount for lack of marketability, is it's a private company. Those common shares will probably not exchange hands or be liquid for a number of years when an M&A event occurs or when an IPO occurs. And as such, they're not worth as much today in a liquid market as they were in a private market. So there's a time frame component and there's a market basis component. And the IRS allows the recipients of any grants to take an appropriate discount for lack of marketability. And those ranges can be anywhere from very small, from 5-10%, all the way up to 35% discount for lack of marketability. Those are really important components to have in the analysis to support, a strike price that is supportable and, as Dan mentioned earlier, perhaps on the lower end of the range to give employees as much upside, being able to take both those discounts for a DLOC and for a DLOM.
And for those discounts, I mean, you've got the IRS, you also have the SEC kind of weighing in on these things as well, providing some guidance on where these things should sit. And so you might be thinking, hey, I'm a private company. How does the SEC figure into this mix? But they have weighed in on this, especially as companies are going through that period of bridging from a private to a public company, and maybe they do a round of financing, and there's a bunch of equity activity that's happening in the last 90 days before the IPO hits, and the SEC has gotten involved there related to these issues, which kind of then trickles down to how you're dealing with these issues with a company that was seed funded that might be 10 years away from that point.
Yeah, the SEC has issued guidance, particularly on the DLOC component. If there's a recent financing, generally the SEC has said, we don't believe the valuation should have a discount for lack of control because it's embedded in the discount for lack of marketability. A minority interest is less marketable than a majority interest. And so there's some complexity there, Dan, and that's probably beyond the scope of this call, knowing that the SEC has gotten involved, the IRS has gotten involved, the AICPA has guidance as well, and being able to navigate that. And again, it's not just a formulaic approach. It depends on the circumstances of the business, and we can help navigate that to ensure it's defensible and get the appropriate discounts, including the report.
So we're at 1 o'clock. I wanted to thank Bryson for joining us today. I wanted to ask him, do you mind sticking around to answer a few more questions that are popping up? But I know that everyone else, I want to be respectful of your time. You may have only had till 1 p.m. blocked out on the calendar. And so if you have to leave us, thank you for joining. Remember, we do have a promotion running until June 30th. You can go to earlygrowth.com/409promo to get information on that. And we will be following up with an email. For everyone else who's sticking around, keep your questions coming into the Q&A in the chat, and maybe we'll get to 2 or 3 more questions here. Okay, so the last chatted question to come in is in regards to a SAR. And so maybe you can talk a little bit about what a SAR is, and if a 409A valuation is needed if you're awarding SARs.
Boy, I am not that familiar with SARs, actually. I haven't done a lot of work on SARs, Dan.
Okay, so that's a grant that instead of giving someone equity, you're giving someone the value of the appreciation of the equity.
Mhm. Yeah, I know in concept what it is. I'm not certain where it falls in the
Okay.
in the foreign NA world. To me, it sounds like you need to establish what that basis is in order to determine what the appreciation of what, right? And so there would be evaluation. I'm not sure if it falls under foreign NA or not, but to me, you know, you would have to have a basis in order to establish what the baseline value would be.
Right, right. Um, so, you know, the rule of thumb that I've basically used, like a SAR is not an equity instrument, but it's a compensation instrument. It's basically saying, I'm going to pay you if the value of our equity goes up. But you never get any equity, so you never actually change the underlying equity. It's pretty likely that there's a compensation element to it. I've been well out of the finance game and haven't actually personally dealt with SARs in any of the businesses that I've started or been a part of over the last 15 years, but I'm going to guess that there's something similar to the Black-Scholes model to try to help value that, and it's going to have a compensation element. Okay.
Yeah, I'd have to get my partner, who's my SARS expert, on this one, because that's a little bit outside my world.
Yeah. There was a question around vesting. Is a valuation only needed at the time of the grant, or what happens as stock options vest? Does that have any impact on the tax treatment or the need for an updated valuation?
Yeah, it depends on the instrument that is being granted, but most instruments on the grant date, the taxability of the instrument is important, because there are certain instruments that are taxed as value as that instrument appreciates in value. And as such, the valuation, again, it's a private company. And so when does that tax bill have to be calculated? Does it have to be calculated at vesting milestone events, or is it only calculated on disposition of that equity instrument? And at disposition, you know what it's worth because you disposed of it. And so it really comes down to the instrument and the taxability and the timing of those taxabilities of when that valuation is needed. Most non-qualified deferred compensation instruments, they're not taxed on grant, if they're granted at the money, there's no tax liability. If they're granted in the money, there's a tax liability. And when vesting occurs, there's not a tax liability, only upon disposition again. So there are other instruments that are the opposite. And so when there's a tax calculation that's needed, you'd want a valuation to support that tax calculation.
So one of the things I love about these webinars is we had someone, an attendee here, who shared a little bit more guidance to the last question about SARs, which is that she's with a company called Option Tracks, Elena Thomas, and said, most companies use the Black-Scholes model for SARs as well as options. So Elena, thanks for that input. Okay, I think we had one more question in here. And this was from Elisa Selvo. And I might need to get a little bit more clarification of your question here, Elisa, but it was, as you grant options over time, the exercise price is changing. Your older employees are going to have a lower exercise price. Your newer employees are going to have an increased one. When it comes to the valuation and the tax impact, what are you doing there? Are you making any adjustments that go on? Do the older employers continue to get stock options at the same price, or is their exercise price increasing with new grants? The old options stay in place, that's okay. You can provide just a little kind of basic guidance there. And Alyssa, if that's not exactly your question and you're still on, just add to the chat and we'll try to get to it.
Yeah, that's a common challenge that we see is earlier employees may have a higher strike price than latter employees. And the most common case that I see is canceling those earlier stock options that were granted at a higher strike price, or amending them and reissuing them at the lower strike price. Now that then has the later employees and the earlier employees now with the same strike price. And the question then becomes, well, how do I get them a lower strike price than the later employees, because they've been here longer? They should deserve some appreciation. And generally, without there being a tax, you can do that, but there's a tax liability to those recipients of those lower strike prices options. And so that oftentimes there's another mechanism in place to help give them a greater benefit. Maybe there's more options given to them at the same strike price, or accelerated vesting rather than the normal vesting schedules, or immediate vesting. There can also be maybe a cash component outside of equity, right? If you stay here X number of years, we'll bonus you a certain amount. Or if, so there's other structures. Usually it's not through the option structure itself and the strike price. The strike price has some tax implications. It's something else. Vesting is the biggest one I see, the number of options, and then a cash component outside of the grant.
Yeah, what I've also seen is just giving people shares. And there's a tax component to that. There's a compensation component. And so you'll often give shares plus a cash amount to cover their taxes. And by giving them that cash, it's generating more taxes. So you need to gross it up. Yeah. And that's a way to take care of it. But to kind of get the award out there and basically say, hey, we're not going to give you an option with an exercise price, we're just going to give you the shares. But the 409A valuation comes in as a key input to calculating what the compensation is, and then figuring out how to gross it up so that the person who's getting those shares doesn't end up having a tax bill that they have to pay out of pocket. There is one more question that is a really good question and really important, especially from the founder perspective, that I want to get to wrap us up here and bring us home. And this was from Anna Ratala. And the question is, does a 409A valuation play any part in future fundraising? Do investors ever refer to it as a basis of valuation conversations? Because as I sit here and go, hey, I want the 409A valuation to be low, I certainly don't want a future investor to use that against me. And so what's your experience? Do these things come up in fundraisings going forward? How is this looked at in the future? Does it come up if you're in conversations with someone that might potentially acquire you? Are they looking at your past 409A valuations, and why? How are they looking?
Yeah, this is an important question. Most professional investors in the early stage that circle around early stage businesses recognize the difference between a tax valuation, which is this, and a post-money valuation or pre-money valuation, which is what they invest under. And that that there may be differences between those conclusions. And so most early stage investors may ask to see the report, or they may ask solely, are you, quote, 409A compliant? Meaning, do you have evaluation to support your option grants? Most do not, in my experience, use that valuation as leverage on their side to push down the price because they understand it's a tax valuation. Acquirers, for more mature businesses, and eventually that IRS tax valuation is going to align closer and closer to the exit value, because that's the exit value of that business. And acquirers, again, in my experience, may ask to see those reports and may ask if you're compliant. But in my experience, they don't generally use this as a negotiating item for the sellers of the business. Dan, that's been my experience.
So there's a great question to finish on. I know acquirers will ask to see your 409As. They may dig in a little bit. My experience has been that's coming from the perspective of just trying to evaluate if there's any tax liability that's out there that they might be acquiring when they acquire the business. But no, most professional investors or acquirers are not going to hold your 409A valuation against you. They understand that you're trying to drive it lower. You want to drive it as low as you can possibly drive it and still feel comfortable that it's going to stand up to audit. Back to what we talked about in the beginning, the reason why you do a 409A is because the IRS is there saying you need to support for fair market value in granting these deferred compensation instruments. Bryson, it would be wonderful to spend some time with you. It's been 5-6 years since we started working together, and it was really fun to be able to do this and share this information with some entrepreneurs out there. For everyone who joined, thank you for coming today. Again, we'll follow up with recording the presentation, and if you're interested in learning more about what early growth does in general for early stage companies or help with a 409A valuation, just please reach out to us, and you can learn more about our promotion at earlygrowth.com/409promo. Thank you, everyone, and have a great day.
Thanks, everybody.